interesting. So owning a home
Mhm,
builds money in the home. Am I correct?
mhm.
Okay.
Yeah, that's historically what it does.
Now, a home you can then take a loan out on, or you can take an extra loan out on. How does that process work? Like, what are the options on that?
Okay, so you could either do what is called a cash out refinance. Let's just say you owe 200 on the house and the house is worth 400. Okay, maybe you need to get $100,000. So you redo the whole loan, new interest rate, new payment, and everything's all at one payment for, let's say, $300,000.
Mhm.
Okay, that's one way to approach it. Number two, you keep your existing first mortgage and then you use the difference between how much is owed on it and the value of the home to get a home equity line. They'll let you go up to a certain percentage of the total um, value of your home. So, for
Okay.
example, let's say you did it as your primary home, maybe go up to 90% of your home's value. If it's 400,000, that's 360. 200, you get up to 160,000. Maybe you have something in mind that you need to have done to the house. God forbid something happened with you and your family. Maybe you're trying to get another property. Who knows? Just an idea. Those are some things that you could
Okay.
do.
Now,
But the sorry, go ahead.
sorry, I was just going to go into a little bit more detail. Are there, without being, being a little bit general, I guess, are there stipulations on, like, can I take the money out and just go buy another home, or can I take the money out and go buy, my favorite car that I've wanted and I'm going through a midlife crisis and I can now afford it? Like, what can I start a business with that money? Like, what can I do with that money? Is there stipulations?
There's so many examples I can use, but I'll give you one right now. So let's say
Okay.
you go to the bank and you're saying, "Hey, I need to do a home equity line." And they're like, "The
Yeah.
only way you're going to qualify is you pay off your $50,000 in credit card debt. Are you going to do that?" And the bank might force you to have that paid at closing. So they'll take proceeds from the home equity. Or sometimes they'll say, "Your credit's pretty good. We'll trust that you do that." But if we find out you did it, theoretically, they could call the loan and just cut the line off. So it's best to
Right.
try to stay within the box that is outlined by the underwriter and the bank themselves. But
Now,
you
of
could
course,
also,
there are ins and outs in working
well,
the system,
well,
right?
well, I mean, I'll give you a simple example right here. Let's say you have decent credit and you don't have to pay off anything to qualify for what you're trying to do, and the bank just feels really comfortable, warm, and fuzzy about you. They might say, "Sure, go ahead, take 150,000. I'll just make your payments."
Okay.
Could be as simple as that. They're not going to ask you any additional questions. So really it comes
So,
down to your credit worthiness, your debt ratios, and sometimes just
so
your history maybe with the bank.
individualized is what it sounds like.
Correct. Yeah.
Very,
There's
very
really no blanket
individualized.
statement. I mean,
Yeah.
yeah, you can cover a lot of generalities, but there's no perfect answer unless I get the specifics of your situation.
So if somebody in Virginia had some specifics, would it be something you'd be willing to talk to them about, just if they had questions?
Absolutely.
Awesome. Okay.
Yeah,
Um,
I could literally have a license hanging, within a day for really any place that I